Well, welcome back to Financial Accounting 1. Purpose of this little mini lecture is to review exam number 2. So on the first page, you'll see your grading. So there were 20 multiple choice questions. So when I did your grade, I took the number you got correct and multiplied by 3. So that gave you your score for the multiple choice. The maximum you could have gotten there was 60. And then each of the 4 little exercises or problems were worth 10 points each. So that's how it was scored. And let's go through and let's thoughtfully consider each of the questions here. An enterprise which sells goods to consumers is known as a retailer. So a retailer basically is any enterprise that buys goods from a supplier in large quantity and then turns around and sells them in smaller quantities to a consumer. That's called a retailer. Number 2, the journal entry to record the return of merchandise purchased on account under a perpetual system of inventory. Remember, a perpetual system of inventory, every time you have a purchase of inventory, every time you have a sale of inventory, every time you have a return of inventory, anytime you have any cost that has to do with inventory, it's posted to the inventory account. So the correct answer there is D as in dog. Number 4, a credit sale of $4,000 is made on April 25th, terms 310 net 30, with a return of $300 is granted on April 28th. What is the amount paid on May 4th? Well, if they pay by May 4th, that's within the 10-day discount period, and they're entitled to take a 3% discount, but it's not 3% times 4,000. It's the 4,000 reduced by the 300, so that gives you $3,700. And if you multiply that by 3%, you get a $111 discount. If you take 3,700 and subtract out that discount of 111, the amount of cash that will be received is A3589. Number 4, a merchandising company using a perpetual inventory system will make, they have one more adjusting entry, so you have to correct the balance of the inventory account at the end of the period. So service enterprises will not have an adjusting entry to adjust the inventory. Merchandising companies will. Any retailer is going to have an additional. Anytime you buy and sell goods, you're going to have to adjust the inventory at the end of the period. Service organization would not have that. So the answer there is B. Number 5, on the balance sheet, ending inventory is reported as a current asset. Remember, the assets are recorded in order of liquidity. So you'd have cash, you'd have accounts receivable, and then you would have inventory. So inventory would come right after accounts receivable. So it can be converted into cash, but it's not as readily converted into cash as accounts receivable is. It would actually be above prepaid expenses. All right, so the answer there is A. Number 6, inventory's effect. Well, the value that you put on inventory is going to have an effect on the balance sheet because you have the asset account inventory. And it's also going to affect cost of goods sold on the income statement as well. So inventory affects both the balance sheet and the income statement. Remember, on the income statement, we've got cost of goods sold, we got beginning inventory plus purchases gives us goods available minus ending inventory gives us cost of goods sold. So whatever we have both in the beginning inventory and the ending inventory is going to have an effect on cost of goods sold on the income statement. So for 6, the answer is C. 7, in a period of rising costs, FIFO. FIFO is your inventory is made up of your most recent costs. So FIFO, if you get a period of rising prices, FIFO will give you the highest ending inventory. And if it gives you the highest ending inventory, it'll give you the lower cost of goods sold. So remember, beginning inventory plus purchases gives you goods available, minus ending inventory gives us cost of goods sold. So FIFO, if prices are rising, your ending inventory is going to be high as a result of the rising prices. And since you subtract ending inventory from goods available to get cost of goods sold, you're going to have a lower cost of goods sold than you would have under LIFO. FIFO means first in, first out. LIFO is just the opposite, means last in, first out. Number 8, inventoryable costs include all of the following except freight would become part of the inventory, cost of the beginning inventory, cost of all the goods purchased, that would all become part of the cost. Cost of purchasing and warehousing departments, those are more administrative costs. Those are not actually become part of the inventory. Inventory costs will be all those things directly related to the purchase of the inventory, including freight costs, It wouldn't include the cost of operating purchasing departments and warehousing departments. Number 9, if beginning inventory is understated by 15,000, the effect of the error on the current period is. Again, think of the cost of goods sold calculation. So I want to write it down here. Beginning inventory plus purchases gives us goods available, minus ending inventory gives us cost of goods sold. So if beginning inventory is understated, that means that the cost of goods sold is understated, because that's one of the things you add is beginning inventory. That's your starting point. And if your cost of goods sold is understated, then your net income is going to be overstated. So the correct answer there is C, as in cat. Number 10, the lower of cost or net realizable value basis of valuing inventory. That's an example of the doctrine of conservatism, which says that we should postpone revenue as long as possible and should recognize expenses as soon as possible. So if you're recognizing the reduction in the value of the inventory before the inventory is actually sold, that would be a manifestation of the accounting concept of conservatism. Number 11, which of the following is not one of the main factors that contribute to fraudulent activity? So remember, this was the fraud triangle. So if you have the opportunity, you've got the financial pressure, you've got the rationalization, you will have a fraud. Incompatible duties, that's something we do to prevent fraud, but it's not one of the things that actually contributes to fraudulent activity, whereas the other three do. So the one that doesn't belong there is B, as in boy. Number 12, all the following requirements about internal controls were enacted under the Sarbanes-Oxley, except, so remember Sarbanes-Oxley, that was the law that Congress passed after the Enron fiasco. So it did require independent auditors to attest to the level of internal control. Companies did have to develop sound internal controls. Companies had to assess the functionality of the internal controls. What it didn't do, it says independent auditors must eliminate redundant. That's not part of Sarbanes-Oxley. So auditors are not required to eliminate redundant internal controls. In fact, they may want to have redundant internal controls to prevent fraud. Okay. Correct answer is D. The use of remittance advices. So these are things that we prepare to show how much cash is received. That's an example of a documentation procedure. Anytime you have source documents to document a transaction, that's documentation, and a remittance advice would be a form of documentation. Number 14, a bank statement. This is simply a statement that we get from the bank. It shows the activity, which is either increase or decrease in the depositor's account balance per the bank. Right? So it doesn't, let's take a look at the ones. By process of elimination, allows the depositor to know the financial position of the bank. Nothing to do with the financial position of the bank. Is a credit reference letter? No, nothing to do with that. Is a bill from the bank? No, bank doesn't bill us. What the bank does, if we owe money to the bank, they take it out of our account. So the correct answer is D. It shows the activity which increased or decreased the depositor's account balance from the perspective of the bank. When we get to the bank reconciliation, you're going to see that things in the books and the bank statement don't always show up at the same time, which is why we do a bank reconciliation. 15, which when cash is reported on the balance sheet as a current asset, it consists of each of the following. Does it include checks? Yes. Does it include money orders? Yes. It doesn't include restricted cash. So restricted cash is cash that's set aside for a particular purpose, maybe as like rent deposit that we have from a tenant, or maybe money that's going into a particular fund to buy a piece of property at a later point. So restricted cash is not part of the current asset account cash. 16, interest is usually associated with a note receivable. This is the difference between a note receivable and an account receivable. Account receivable is that we have an expectation that will be paid within a certain period of time. So the terms of usually like, 210 that 30, we expect to be paid in 30 days. There's no guarantee we're going to be paid in 30 days. But if you have a note receivable, that is a stronger legal claim. And a note receivable usually has a due date, and it usually has interest. So interest is usually associated with a note receivable, not an account receivable or doubtful accounts or bad debts. 17, when the allowance method for recognizing bad debts expense is used, the entry to recognize the expense. So under the allowance method, when you recognize the expense of bad debts, you actually recognize the bad debt before any individual account goes bad. And you do that by debiting bad debts expense, and you credit allowance for doubtful accounts. allowance for doubtful accounts is a contra asset, meaning it's an asset account with a credit balance. So when you figure out what the net receivables are, it would be accounts receivable less the allowance. So anytime you recognize bad debt expense, since allowance for doubtful accounts is subtracted from accounts receivable, it actually decreases the current assets. Number 18, the direct write-off method. Direct write-off, when you write off the account, you just debit bad debts expense and you credit accounts receivable. Nice and simple. But it only shows your actual losses from individual uncollectible accounts. It doesn't show, based on your past experience, how much of your accounts receivable going forward is going to prove to be uncollectible. So direct write-off method shows the actual losses from uncollectible accounts. Okay, it is not acceptable for financial reporting purposes. It doesn't debit allowance for doubtful accounts to record the write-off. It's just simply a debit to bad debts and a credit to the accounts receivable, and it doesn't involve any estimates. So the answer there is C. Two more, multiple choice that is. The two key parties to a promissory note, that's the maker, person who promises to pay, and the payee, that's the person who the money and interest will be paid to at the end of the term of the note. And then the last one, what they want is the accounts receivable turnover. So the accounts receivable turnover, you would take the credit sales of 1,300,000, and you got to divide that by the average of 185 and 140. So I think that average is 162,500. So take 1,300,000, divide by 162,500, and you should get 8, and that's the answer there. C is 8. Okay, so 20 multiple choice questions worth 3 points each, and then 4 short little problems here. So the adjusted trial balance contained the following information. So these are all the accounts. So what you need to do is you need to prepare a multiple step income statement. This is my Wayne Gretzky analogy. So you got to get a mental picture of what this thing is going to look like before you try to do it. So you're going to have net sales. You're going to subtract out cost of goods sold. You're going to then from that, you're going to get gross profit. And from that, you're going to subtract out your operating expenses. And then you're going to end up with something called income from operations. And then you've got to have the other income and the other expenses. That would give you net income. If we had income taxes, we'd include income taxes at the bottom, but we don't have income taxes in this problem. All right, so here's your, so you got to start out with the net sales. So it's the revenues minus the returns and allowances. That gives me net sales. Subtract out the cost of goods sold. This is why it's called multiple step. That gives you the gross profit. Subtract out the operating expenses. So all these things here are operating expenses. And then that would give us income from operations of 51,000. That's not the net income, because you have other revenues of interest income, and you've got other expenses of interest expense. So to get full credit on this, you had to show all the items, and you had to show all the different steps there. Most of you did okay on this. Some of you just completely lost the boat on this. I don't know what you were doing. You got confused between the income statement and the balance sheet. So this is the income statement. Get that mental picture. You get net sales, subtract out cost of goods sold, gives you gross profit. Subtract out the operating expenses, that gives you income from operations. Then you add other revenues and other expenses, that gives you. Next one was pretty simple. This was a inventory shows the following. Physical inventory. So if you add up all these units together, looks like the company had available for sale 900 units, and there were 250 units on hand at the end of the period. So what you need to do is you need to assign the value to the ending inventory based on 250 units, and you got to use the LIFO inventory periodic, which means you got to go all the way back and say, what is my oldest possible inventory cost? So my oldest possible inventory cost is September 1st. I had 100 units at 335, but I had 250 units at the end of the period. I only had 100 at those. So I need another 150 units. So I go back to the next most recent purchase, to the oldest one, and we purchased 450 units at 350. So I take another 150 units at that 350. There's my ending inventory. And cost of goods sold, you can get at in a couple of ways. You can start at the bottom and say, okay, what's left over? So you had 350 units at this price. And then of the 450 you had at this price, 150 of them are included in ending inventory. So you got 300 units at that price. So there's my cost of goods sold. The other way you could have gotten this is you could have just added up all the inventory costs, this times this, you add up a column here and get your goods available, subtracting out your ending inventory, and that would give you your cost of goods sold. So how you got there really didn't matter as long as you got there. Right? So you had to get full credit. You had to show calculations for both ending inventory and cost of goods sold. And this was under LIFO. You would have gotten a very different answer if you had used FIFO or weighted average. Next one, and quite a few of you really screwed this thing up. So I thought I was making life simple for you. So rather than doing the actual bank reconciliation, I tested you on your knowledge of where things go. Okay, so you have to look at each one of these things. So outstanding checks, what are these are the choices here. So it's either add to the balance per the books, deduct from the balance per the books, add to the cash balance per the bank, deduct from the cash balance for the banks, or does not affect the bank reconciliation. So the first one, outstanding checks, that would be a reduction of the balance per the bank. So the answer there is D. Bank service charge, that's already on the bank statement, but I have to reduce my, that's a deduction on the balance per my books, which is B. Number 3, a check for $320 was correctly written and paid by the bank, but incorrectly entered in the cash payments journal of $230. So I understated in my records the amount of the check looks like by $90 here. So that would be a deduction for the balance per my books. So that would be 3 would be B. Number 4, deposit in transit. That means I've made a deposit. I've shown it in my books, but it doesn't show up on the bank statement. So a deposit in transit is in addition to the balance per the bank statement. So 4 is C. Number 5, bank return deposited check marked insufficient funds. That means that I deposited a check and it bounced, which means the bank is going to deduct that out of my account. They've already done that on the bank statement, so I got to deduct that for the balance per my books. So the answer to 5 is B. 6, bank collects note receivable and interest from the depositor. So that means that the bank already shows up on the bank statement, but I don't show it on my books yet. So that's going to be in addition to my books. So that's 6 is A. Number 7, bank memorandum for check printing fees. That means the bank took money out of my account for printing new checks. So that would be a reduction of for my books. So the answer to 7 is B. 8, petty cash custodian has $91 in paid petty cash vouchers and has not yet been reimbursed. That has no effect because we haven't replenished the petty cash fund. At the point where we replenish the petty cash fund, then that would have an effect on cash, but we would have already recorded that in our books. So petty cash, the fact that he's got $91 worth of receipts would have no effect on the bank reconciliation. So the answer there would be E. Number 9, bank charged a check against the company which should have been charged to another company. This is rare that this happens, but the bank took money out of our account that they shouldn't have. So that would be an addition to the balance per the bank, and that would be C. And then last one, a check for $158 was correctly paid by the bank, but incorrectly entered in the cash payments journal at $185. So we overstated the amount of the check. So we have to make that an add to the balance per our book. So the answer there is A. Okay. So please, when you get your exam, make note of these. If you're still struggling with these, take a look at an actual bank reconciliation. I thought I was making it easier for you, but maybe it would have been easier if you had done the bank rec. I don't know. But these, you have to know each of these things to actually do a bank reconciliation. Okay. And then the last one here was, I thought was pretty simple. So you got 2 scenarios and you got to do the bad. I didn't ask for the whole entry. I just asked for the bad debts expense. So first one, estimate 8% of accounts receivable will be uncollectible. So you take accounts receivable 160 and you multiply by 8%. And I think that gives you 12,800. But there is an allowance. The allowance for doubtful account has a credit balance of 980. So it's 160,000 times 8% is 12,800. Subtract out the 980, and you get 11,820 right here. And then B, we change the facts here. Estimate that 10% of accounts receivable will be uncollectible. So 10% of 160, that's easy. I can do that in my head. That's 16,000. But here, you had a debit balance in the allowance for doubtful accounts. So you have to take that 16,000 and add 400 to it. Okay, so that's it. Let me stop sharing here. So when you get your exams, I'll give those back tonight being Wednesday evening. I'll give them back at the end of class, so you're not, focused just on the exam. And listen to this video. Make sure you have the exam in front of you, so you can go over what you did, and hopefully you can see the error of your ways. I made a decision, since we missed one class, to make the take-home exam. Please don't lull that into a false sense of confidence. Probably some of you really need to do well to pass the course, so you want to make sure you do especially well on the take-home exam. And the best way that you can do that is to come to class, ask questions, do the homework, and particularly review those exercises we do in class as well, to make sure, because the exam is likely to be more problems than multiple choice. Okay, so I look forward to seeing you this evening, and I hope you found this review of the exam useful. Adios, au revoir. Spock wishes you a good evening. That does my treble as well. Take care, everybody. See you this evening.